Imagine a headline that would send shockwaves through every corner of the global economy. China accepts US trade offer. For years, we've watched the world's two economic titans locked in a dance of tariffs, counter-tariffs, and strategic competition. Tensions have mounted, supply chains have fractured, and the very future of global trade has hung in the balance. But what if, suddenly, that tension eased? What if a breakthrough deal was struck, not just a temporary truce, but a genuine acceptance of a substantial trade offer? What really happens next? Is it a new dawn of unprecedented cooperation, or merely a strategic pause before the next round of geopolitical chess? The implications are colossal, touching everything from the price of your smartphone to the stability of nations. Stick around, because today, we're unpacking this monumental hypothetical, exploring the immediate aftermath, the profound economic shifts, the geopolitical rebalancing, and the ripple effects that would redefine our world. Welcome back to Top Travelor, your source for deep dives into the forces shaping our world. For too long, the narrative between the United States and China has been dominated by friction. From concerns over intellectual property theft and forced technology transfer to massive trade imbalances and industrial subsidies, the issues have been complex and deeply entrenched. We've seen cycles of escalation, with tariffs reaching dizzying heights, as high as 145% on some Chinese goods by the US, and 125% on American imports by China, as we've witnessed even recently in early 2025. The recent 90-day truce, which saw these punitive tariffs significantly rolled back to a baseline of around 30% for the US and 10% for China, offered a much-needed breath of fresh air. Markets surged, businesses exhaled. But critically, that was a temporary de-escalation, a ceasefire, designed to buy time for deeper negotiations. Today, we're going beyond that temporary reprieve. We're asking, what if China genuinely accepted a comprehensive US trade offer, one that addresses not just tariffs, but structural issues, market access, and fairer competition? This isn't just about trade numbers. It's about trust, power, and the future of global order. Let's break down what happens next. The moment the news breaks that a comprehensive US-China trade offer has been definitively accepted, the world would react in a cascade of ways. We'd see an immediate, dramatic rally across global stock exchanges. The Dow Jones, Nasdaq, S&P 500, Shanghai Composite, Hang Seng, and European indices would all surge. This isn't just about short-term gains, it reflects a massive reduction in systemic risk. Companies that have been hit hardest by tariffs, from manufacturing and agriculture to technology and retail, would see their stock prices skyrocket. Think about American agricultural giants like Cargill or Archer-Daniels-Midland, or tech behemoths like Apple, Nvidia, and Qualcomm, heavily reliant on Chinese manufacturing or markets. Their shares would climb significantly. Detail how specific sectors would react. For example, tech firms like Apple, heavily reliant on Chinese assembly, would breathe a massive sigh of relief as supply chain costs reduce and market access becomes clearer. Agricultural exporters, especially soybean farmers in the US, would see demand from China rebound, alleviating years of market uncertainty. The US dollar, which often acts as a safe haven during uncertainty, might initially weaken slightly against other currencies as risk appetite returns. However, the Chinese yuan would likely strengthen as investor confidence in China's economic outlook improves, potentially leading to more balanced exchange rates. Prices for raw materials, especially those sensitive to global demand and supply chain stability like oil, industrial metals, copper, aluminum, and agricultural commodities, would likely see an upward trend as global trade volume is projected to increase. This could signal renewed economic activity. Government bonds, typically seen as safe assets during times of uncertainty, might see a slight dip in demand, leading to a rise in yields as investors shift towards riskier, higher return assets like equities. Both Washington and Beijing would issue triumphant statements emphasizing mutual benefit, stability, and a new era of cooperation. Phrases like win-win solution, shared prosperity, and strengthening global economic governance would dominate headlines. Example, refer to previous Phase 1 deal rhetoric, but amplify it significantly to reflect a more comprehensive agreement. Major international bodies like the WTO, IMF, and World Bank, along with leaders from allied nations, EU, Japan, South Korea, would welcome the deal as a critical step for global economic recovery and stability. It would be seen as a de-risking of the global geopolitical landscape. Expect immediate announcements of revived bilateral dialogues across various sectors: economic, strategic, security, and even climate change. This would signal a more constructive and predictable engagement. Consumers in both countries would likely feel a sense of relief. Anticipation of lower prices on imported goods, due to reduced tariffs, and increased product availability would contribute to a rise in consumer confidence. This is crucial for stimulating domestic demand. US consumers might see price drops on electronics, clothing, and everyday goods that were subject to tariffs. Chinese consumers might see more competitive pricing on American goods. Companies that had delayed expansion plans, capital investments, or supply chain diversification due to trade uncertainty would likely restart these initiatives. This would fuel job creation and economic growth. Refer to surveys showing business hesitation to invest during trade tensions. Lingering skepticism and trust deficit. Crucially, the euphoria would be tempered by a significant degree of skepticism. Years of trade disputes, broken promises, like China's import commitments in the Phase 1 deal, and deep-seated mistrust would not vanish overnight. Many analysts and politicians would view the agreement as a truce rather than a permanent peace. The wounds of the trade war are deep. A single bandage won't heal them instantly. Quote a hypothetical analyst saying, "This is a necessary first step, but the devil is in the details of enforcement and whether fundamental structural issues like state subsidies are truly addressed." While the immediate reaction is one of relief, the long-term economic shifts triggered by such a comprehensive trade deal would be profound and multifaceted. The primary and most direct impact would be the drastic reduction, or even elimination, of tariffs on a vast array of goods. This would immediately lower import costs for businesses and potentially consumer prices. If tariffs were to fully reverse to pre-2018 levels, it would inject hundreds of billions of dollars back into the global economy annually. Re-globalization and trade rebound. Expect a substantial rebound in bilateral trade volumes. Industries previously hit hard, such as US agriculture, soybeans, pork, dairy, and Chinese manufacturing, electronics, machinery, textiles, would see a rapid resurgence. Illustrate with hypothetical percentage increases in trade volumes for specific sectors in the first year. Re-evaluation of friend-shoring and de-risking. While some companies had already moved supply chains out of China or diversified to friend-shoring locations like Vietnam, Mexico, or India, a new deal might cause a re-evaluation. The economic incentives for staying in or returning to China would strengthen due to reduced costs and greater market access, though some strategic diversification would likely remain. Companies might pause new investments in alternative manufacturing hubs if China becomes significantly more attractive again. A massive win for American farmers, as China would likely resume large-scale purchases of agricultural products, which were severely curtailed during the trade war. This would stabilize farm incomes and reduce the need for government subsidies. Mixed impact. Some US manufacturers that benefited from tariffs, e.g., steel, aluminum, might face renewed competition. However, those relying on Chinese components or exporting to China would see significant cost reductions and market opportunities. The focus would shift to high-value, specialized manufacturing in the US, leveraging efficiency gains from global supply chains. Boost for traditional manufacturing, especially in export-oriented coastal regions. Reduced tariffs would increase demand for Chinese goods globally. However, China would also face pressure to open its markets to US goods and services, potentially increasing competition for some domestic industries. This is perhaps the most complex sector. While a trade deal implies a reduction in general tariffs, the underlying tech competition, especially in semiconductors, AI, and 5G, often stems from national security concerns, not just trade imbalances. A trade deal might ease some export controls or allow for more robust R&D collaboration, but it's unlikely to fully reverse the trend of technological decoupling in strategic areas, especially where dual-use technologies are concerned. US companies like Intel or Nvidia might find better market access for less restricted products, but highly advanced chip sales would still be scrutinized. A comprehensive deal would likely include provisions for greater market access for US service providers in China, financial services, cloud computing, entertainment, healthcare. This would be a significant boon for US companies. Both countries could see a new PTICK in FDI. US companies would be more willing to invest in China given reduced risks and clearer regulatory pathways, and vice versa. The unwinding of trade barriers and renewed confidence would provide a significant boost to global economic growth. Estimates suggest the trade war cost the global economy hundreds of billions of dollars annually. Reversing this would unlock substantial growth potential. Cite a hypothetical forecast from IMF or World Bank on global GDP growth improvement post-deal. Tariffs act as a tax on consumers and businesses, contributing to inflation. Their removal would alleviate some inflationary pressures, especially in countries like the US that heavily import consumer goods from China. For both countries, a stable and growing trade relationship could lead to increased tax revenues and a healthier economic outlook, potentially easing pressures on national debts, though this is a long-term effect. A major component of any US trade offer would be stronger commitments from China on protecting IP, ending forced technology transfers, and ensuring fair competition for foreign firms. This would include robust enforcement mechanisms. New laws, stricter penalties for IP infringement, improved patent application processes for foreign firms. State-owned enterprises, SOEs, and subsidies. This is a deeply contentious issue. A comprehensive deal might seek to limit state subsidies to Chinese SOEs, which the US argues distort market competition. However, China's economic model is heavily reliant on SOEs, making significant concessions here difficult. Any progress would signal a fundamental shift. This would be a true test of China's willingness to reform its state-led economic model. The deal would likely include provisions for greater market access in sectors where foreign companies currently face restrictions or unequal treatment, such as cloud computing, financial services, and healthcare. Beyond economics, a major trade deal would reverberate through the geopolitical landscape, recalibrating alliances and global power dynamics. A comprehensive US-China deal could breathe new life into the World Trade Organization, WTO, which has been largely paralyzed by the US-China trade war and the US blocking of appellate body appointments. Both nations might commit to strengthening and reforming the WTO. The WTO's effectiveness has been severely hampered by the US-China dispute. These forums could become more productive platforms for global economic coordination, rather than battlegrounds for trade disputes. With economic tensions eased, there could be greater impetus for the two largest emitters to work together on ambitious climate targets and green technology development. These economies, caught in the middle of the US-China trade war, would breathe a collective sigh of relief. Their own trade with both giants would benefit. They might push for inclusion in aspects of the agreement or seek similar concessions from both sides. These nations have long advocated for a de-escalation, as the trade war disrupted their own supply chains and economic stability. The global shift from outright decoupling from China to de-risking, reducing over-reliance while maintaining engagement, would gain more traction. Allies would welcome a more predictable trade environment. Some allies might feel excluded or that their concerns were not fully addressed in a bilateral deal. The US would need to ensure the deal doesn't inadvertently disadvantage its closest partners or create new trade imbalances elsewhere. While trade in goods and services gets a boost, the competition for technological supremacy is a separate, more complex battle. A trade deal might ease some tensions, but it wouldn't eliminate the underlying strategic rivalry. A core demand of the US offer would be substantially improved IP protection within China. This could include stronger legal frameworks, more efficient enforcement, and a reduction in IP theft and counterfeiting. Increased arrests and prosecutions for IP violations, faster court proceedings for foreign companies. The deal would likely include explicit prohibitions and enforcement mechanisms against practices that pressure foreign companies to transfer technology to Chinese partners as a condition of market access. Proving forced technology transfer is notoriously difficult, so enforcement mechanisms would need to be robust. While strategic export controls on advanced semiconductors and chip-making equipment, like those implemented in late 2024 and early 2025, are rooted in national security, a trade deal might lead to some targeted easing for less critical technologies. For example, licenses for certain mature technology chips or equipment might become easier to obtain. US measures aimed at crippling China's advanced chip manufacturing capabilities are deep-seated. Both the US and China would continue their massive domestic investment drives in semiconductor research, development, and manufacturing. The goal for both remains self-sufficiency in critical components. A trade deal would make this effort more efficient, not necessarily diminish it. A more predictable trade environment could reduce sudden disruptions and improve the overall stability of the highly complex global semiconductor supply chain, benefiting industries worldwide. A comprehensive trade deal would solidify the shift away from a full economic decoupling, complete separation of economies, towards de-risking, reducing over-reliance on a single source, particularly for critical goods, while maintaining broad engagement. Companies would still prioritize supply chain resilience and diversification, learning lessons from past disruptions. This means while trade with China might surge, the concentration of production in China might not return to pre-2018 levels for all products. The genie of diversification is out of the bottle. A trade deal lowers the cost of doing business, but it doesn't erase the strategic imperative to not put all your eggs in one basket. Beyond the macroeconomic and geopolitical shifts, a US-China trade deal would have tangible effects on the daily lives of citizens in both countries. For consumers in the US, a reduction in tariffs means a reduction in import costs. This could translate to lower prices for a wide range of goods, from electronics and apparel to toys and home goods. This would boost purchasing power, especially for lower-income households. Highlight how tariffs were effectively a tax on American consumers. With trade flowing more freely, consumers might see a wider variety of imported goods from both countries, offering more choices. Some domestic industries that benefited from tariff protection might face renewed competition. This could lead to difficult adjustments for specific sectors or regions, potentially requiring government support for retraining or reskilling workers. An accepted trade offer is a crucial step, but it's far from the finish line. The true test lies in the long-term execution and the ability of both nations to navigate the inherent complexities of their relationship. The deal would require strong, transparent, and enforceable mechanisms to ensure compliance, particularly on issues like intellectual property protection, subsidies, and market access. Without trust, verification is paramount. Independent arbitration, regular review mechanisms, and clear dispute resolution processes. Even with a deal, open lines of communication at all levels would be critical to manage future disagreements and prevent them from escalating into new trade wars. Demands for greater transparency in China's economic policies, state subsidies, and regulatory processes would likely be ongoing. The fundamental difference in economic models, US market-driven capitalism versus China's state-led capitalism, remains a persistent source of tension. While a deal might address specific subsidies, it won't fundamentally alter China's economic structure. Issues like human rights in Xinjiang, Hong Kong, and broader civil liberties would likely remain significant friction points, even if trade relations improve. These are often treated as separate from economic relations but can influence the political will for cooperation. The core geopolitical flashpoints, particularly Taiwan, remain deeply sensitive and capable of derailing any economic progress if not managed carefully. A trade deal might reduce economic leverage in such disputes, but not the disputes themselves. A more cooperative US-China trade relationship could pave the way for shared leadership on global challenges, from climate change and pandemics to debt relief for developing nations. Conversely, some might worry about a G2 scenario where the US and China dominate global trade and governance, potentially sidelining other nations or multilateral institutions. The deal's success might also influence the appetite for regional trade blocs and agreements, like CPTPP, RCEP, as alternatives or complements to a more stable US-China trade dynamic. The new equilibrium would likely be characterized by competitive coexistence. Both nations would cooperate where their interests align, e.g., economic stability, climate, but vigorously compete in strategic areas, e.g., military, advanced technology, influence. The normal might be a highly managed, sometimes tense, but fundamentally interconnected relationship, where economic benefits outweigh the costs of full decoupling. Continuous negotiation, the process of managing this complex relationship would be an ongoing negotiation, requiring patience, pragmatism, and a willingness to compromise from both sides. So, China accepts a US trade offer. It's a headline that promises immense relief and opportunity. We've explored the immediate market jubilation, the potential for significant economic resurgence, and the cautious hope for a more stable geopolitical landscape. Supply chains would ease, consumers might see lower prices, and sectors like agriculture could rebound dramatically. But let's be clear, this isn't a magic wand. The deep-seated issues that fueled the trade war, from intellectual property theft to state subsidies and fundamental differences in economic philosophy, would still require diligent enforcement and continuous dialogue. The technological rivalry, driven by national security, would likely continue, albeit perhaps with more clarity on what is off-limits. Ultimately, such an agreement represents a precarious opportunity. It's a chance to pull back from the brink, to rebuild trust, and to foster a more predictable environment for global trade. But its success hinges on sustained political will, robust enforcement, and a mutual understanding that while economic cooperation offers immense benefits, the broader strategic competition between the two giants will undoubtedly persist. The question then shifts from, what happens next? To, can they make it last? And that, my friends, remains the trillion-dollar question. What do you think would happen if China definitively accepted a major US trade offer? Would it truly be a new era, or just a temporary pause? Share your thoughts in the comments below. We love hearing your perspectives and engaging with your insights. If you found this deep dive valuable, please give this video a thumbs up to help us reach more people. And if you want more comprehensive analysis on global economics, geopolitics, and the forces shaping our future, don't forget to subscribe to your channel Top Travelor, and hit that notification bell so you never miss an update. Thanks for watching, and we'll see you in the next video.